Well, good morning, friends. Jaginder Rana here. The topic of the day is new regulatory framework for insurance business in India. New regulatory framework for insurance business in India. So, in a significant move aimed at improving the efficiency and efficacy of the insurance sector and achieving the objective of insurance for all by 2047, the Insurance Regulatory and Development Authority of India has consolidated and amended a number of existing regulations and introduced some new regulations in order to enhance the ease of doing business in this sector. So these regulations aim to establish a digital public platform accessible to all stakeholders, increase coverage to rural and social sector, establish a robust framework for corporate governance of insurers, and enhance the ease of conducting businesses, boost insurance penetration, etc. So the IRDA had in February 2024 published an exposure draft of one such proposed regulations, the IRDAI registration, capital structure, transfer of shares and amalgamation of insurers, regulations 2024. Now, whose impact is coming nowadays. Now, in addition to the regulation or the registration regulations, the IRDAI has now also published the few consolidated regulations like IRDA registration and operating for insurer branches and Lloyd's India regulations 2024. The IRDA Insurance Product Regulation 2024, the IRDA Rural Sector and Motor Third Party Obligations Regulations 2024, the IRDA Protection of Policyholders' Interests, Operations and Allied Matters of Insurance Regulation 2024, and the IRDA Actuarial Finance and Investment Functions of Insurance Regulations 2024. So the new regulations introduced by the IRDA are the IRDA Corporate Governance for Insurance Regulations 2024 and the IRDA Bima Sugam Insurance Electronic Marketplace Regulations 2024. So additionally, the IRDA has also introduced a circular denotifying certain tariffs. So in this update, let's see few key provisions that have become applicable to the insurance regulatory regime from April 1st, 2024 as a consequence of these regulations. So the key provisions are the foreign reinsurer regulation. The foreign reinsurer regulation seeks to encourage the structured advancement of the reinsurance industry in India and modify the IRDAI Lloyd's India Regulations 2016 and the IRDAI registration and operations of branch offices of foreign reinsurers other than Lloyd's Regulations 2015. So they prescribe the eligibility criteria and applicable conditions for foreign applicant entities engaged in the reinsurance business along with the procedures for registration. They also make prescription for operational matters such as the geographical scope, appointment of key managerial personnel, outsourcing, solvency margin, and reporting requirements. The next one is the insurance product regulations. So So the insurance product regulation seeks to establish a cohesive framework to empower insurers to promptly adapt to changing market needs, improve the ease of conducting businesses, and increase insurance coverage. So they consolidate and modify the IRDAI Microinsurance Regulations 2015. The IRDAI Minimum Limits for Annuities and Other Benefits Regulations 2015. The IRDAI Acquisition of Surrender and Paid Up Values Regulation 2015. The IRDAI Health Insurance Regulations 2016. The IRDAI Unit Linked Insurance Product Regulations 2019. And the IRDAI Non-Linked Insurance Products Regulations 2019. So the regulations prescribe principles that would apply to the design, pricing, and development of insurance products. These include factors such as the needs of the customers, transparency and clarity in wordings, terms, coverage, etc., fair premium rates, due consideration to relevant factors of risk appetites, capital availability, insurance costs, and appropriate underwriting pricing and claims management system. In addition to these broad principles, specific provisions are being made applicable to life, general, and health insurance products. So the Board of the Insurers is required to formulate policies covering all areas of product design, underwriting, advertising, and overall management, constitute a product management committee who will be responsible for implementing the foreign policies, constitute an advertising committee comprising some key management persons and one member from the product management committee to approve all advertisements. So several provisions present in the replaced or repealed regulations but not provided for in the insurance product regulations are to be provided for separately by the IRDAI by way of circulars or under the applicable regulations. The next one is the sectoral obligations regulations. So this sectoral obligations regulation seeks to impose obligations on insurers towards rural and socially backward sectors and consolidate and modify the IRDAI obligations of insurers and rural social sector regulations 2050 and the IRDAI obligation of insurers in respect of motor third party insurance business regulations 2015. So they prescribe certain requirements to be complied with by all life, general, and health insurers except the Agriculture Insurance Company Limited and the Export Credit Guarantee Corporation of India to underwrite minimum rural and social sector business within 1 year of the coming into force of these regulations. Life insurers are required to grant coverage to a minimum of 10% of lives. General insurers are required to grant coverage to a minimum of 10% of dwelling, shops, and vehicles, and health insurers are required to grant health and personal accident insurance coverage to a minimum of 10% of lives in at least 25,000 gram panchayats or village council units. So, all life, general, and health insurers are also required to grant coverage to a minimum of 10% of lives as a proportion of total lives covered in the social sector, that is, beneficiaries of government social security schemes. So, in addition, general insurers are also required to increase coverage to vehicles by a prescribed percentage over the previous financial year based on the insurer's market share in such preceding financial year, subject to each insurer underwriting a minimum of 5,000 goods carrying and passenger carrying vehicles, each and 1,000 tractors. For the allocation of the gram panchayats and number of lives, dwelling, shops, and vehicles amongst the insurers will be specified by the IRDAI. Then the policyholder protection regulations. The policyholder protection regulations focus on the importance of implementing standardized procedures and optimal practices by insurers and distribution channels to meet their responsibilities to policyholders, such as addressing grievances and prioritizing policyholders focused governance. So these regulations consolidate and modify the IRDAI manner of receipt of premium regulation 2002, the IRDAI process of business regulation 2015, the IRDAI fees for registering cancellation or charges of nomination regulation 2015, the IRDAI fee for granting written acknowledgement of receipt or notice of assignment of transfer regulation 2015, the IRDAI issuance of e-commerce policies regulation 2016, and the IRDAI outsourcing of activities by Indian insurance regulation 2017. For the IRDAI protection of policyholders interest regulation 2017 and the IRDAI insurance advertisement and disclosures regulations 2021. So these regulations makes prescriptions relating to the protection of policyholders interest and the operations of the insurers. So the Board of Insurers is required to formulate and maintain a policy for the protection of policyholders interest. The regulations provides for broad principles to be followed with respect to the terms and conditions of the insurance policies and provide free look period to policyholders. Further, the regulations also prescribe procedures for claim settlement and grievance redressal. Furthermore, the regulations provide procedural requirement for advertisements, opening places of business within India and outsourcing. And then the actuarial regulations. The actuarial regulations consolidates and modify the IRDA actuarial report and abstract for life insurance business regulation 2016, the IRDA distribution of surplus regulations 2002, the IRDA asset liabilities and solvency margin of life insurance business regulations 2016, the IRDA assets liabilities and solvency margin of general insurance business regulation 2016, the IRDA appointed actuary regulations 2022, the IRDA investment regulations 2016, and the IRDA preparation of financial statement and auditor's report of insurance companies regulations 2002, the IRDA inspection and fee for supply of copies of returns regulations 2015, and the IRDA laws or temporary advances to full-time employees of the insurers regulation 2016. These regulations prescribe the governing principles of the actuarial finances and investment functions of insurers, including reliance on sound actuarial principles, maintaining a minimum control level of solvency margin, maintaining accurate financial statement reflecting on a true and fair picture, proper investments of funds to meet policyholders' liabilities, and ensuring that suitable and adequate resources are available with the insurers to carry out actuarial finance and investment functions. So the Board of the Insurers is required to formulate and maintain policies to govern the areas of actuarial finances and investment functions, such as the bonus distribution philosophy as applicable, assets liability management, and investment and risk management. So these regulations make detailed prescriptions pertaining to the manner, mechanism and modalities of actuarial and financial functions, such as appointment of an actuary and preparation of an actuarial report, valuation of assets and liabilities, determination of the solvency margin, distribution of surplus, accounting principles to be followed, and preparations of financial statements. Then comes the corporate governance regulations. So the corporate governance regulations policy to all insurers except foreign insurers who are governed by the foreign insurance regulations and prescribe detailed requirements of the constitution of the board of the insurer along with committee, key management persons, auditors and other government requirements. So the e-marketplace regulations are there and the tariff circulars are there. So this circular denotifies the tariffs which were previously applicable to certain classes of businesses and insurance, while the premium rates, policy terms and the deductibles were previously controlled and applied uniformly by all underwriters. The tariff circulars states that these requirements will cease to be applicable from April 1st, 2024. So the premiums pertaining to the insurance, motor insurance, engineering insurance, workman compensation insurance and marine sea tariff have been denotified. The foregoing regulations consolidate the previously fragmented and scattered regulatory landscape into well-defined silos. The limited but focused changes have also been introduced, which will serve to improve the ease of operation or operating in the insurance sector and ensure widespread insurance coverage across the country. One insurance for all being the stated objective, the insurance sector is gaining prominence in matters of government policies and is poised for substantial advancements. However, although the obligations to cover 10% of lives and entities in 25,000 villages is laudable, it will create a higher burden on insurance companies who do not have the required penetration in rural and may result in greater losses to the insurance companies, as rural India may not have the appetite to pay premiums that urban India can afford. So these are the changes that the new regulatory framework for insurance businesses in India is having now. And these are the appreciable efforts of the insurance regulator of India. Thank you.